Hi, Dominique, and welcome to another edition of The Week Ahead. At least for myself, choosing a different location than our usual, me calling in from a deserted island in the South Pacific. I'm actually in the Macro Hive office, Thursday afternoon, early evening. How are you doing, more importantly?
Very well, thank you. Enjoying the early fall in Los Angeles. Beautiful.
Nice, nice. Um, okay, cool. Let's kind of dive right in. So just to clarify for everyone listening, it's Thursday afternoon. Obviously the key data that came out, just a timestamp, was CPI today, which I'll give a shameless plug to Sam and the team who have the new CPI or inflation prediction model, which exactly predicted the CPI headline, core, super core, I guess. No.
Core, because super core is not part of the
It's not part of it, yeah.
survey of analysts. And what Sam does is basically he selects the analyst with the strongest track record. And based on that, he makes his own prediction. And yeah, he got it right against the consensus twice in a row.
Yeah. My understanding is he uses machine learning to basically go through, also understand different analysts' bias and putting all that together. And there's also some different aspects of which environments that they have the historical best track record in predicting, and that has consistently significantly outperformed analysts themselves. Um, so anyway, that was great, and it also continues to feed into your higher for longer narrative, which even today we did get some pushback on that, and also pushback even for one more hike this year. And I know that rate has been going up. So first, over the past kind of week, what's your big takeaways, and then let's obviously dive into the week ahead.
So let's start with the Fed. So we had a string of speakers who pushed back against the November hike because of the move up in yields. But I think you had two different types of speakers. On the one hand, you had Jefferson and Logan, who said that there was a substitutability between higher yields and higher Fed funds. And that's why they thought another 2023 hike was not warranted. But then you had Waller, who took a more cautious approach and said basically he wanted to see how the US economy was adapting to higher yields, but did not close the door to another hike this year. And I mean, there are two reasons why I still think a hike is warranted. One is the data, and we'll get into the detail of the CPI in a second. And then there is this feedback loop between Fed speak or Fed policy stance in general and financial conditions. And basically, it's a bit of a mug's game because, conditions tighten, Fed talks dovish, condition softens, Fed talks hawkish. It's a little bit of a losing game.
Right.
Long-standing debate inside the Fed, and basically former Governor Jeremy Stein explained it the best. I mean, there is unavoidable market vol that's going to be generated by policy surprises, because policy surprises are unavoidable because the world is uncertain, and even the Fed and its 300 PhD economists cannot predict everything with a perfect certainty. So there is always going to be policy and ultimately data-generated market volatility. What the Fed can do is to avoid adding volatility on top of that unavoidable volatility. And the Fed adds volatility when it gets into this sort of a tit-for-tat exchange with the market and tries to react to short-term changes in FCI. So I'm I'm with Waller. I think it's more a question of a wait and see, which makes sense given the speed of the move in yields. But if you look at the data, we got a CPI with a marked acceleration in OER. I mean, the Fed has been telling us forever that OER was on autopilot and that it was going to climb down. But actually, for the past 3 months, OER inflation has gone up. Same for core services without housing, which the Fed, based on their latest minutes, is the most concerned about. And then look at the NFP on Friday, and then look at the Atlanta Fed forecast for Q3 GDP. Even the Fed, so one Fed speaker mentioned Q3 above 4%, which is more than twice as fast as the long-term trend. I mean, in my view, monetary tightening is not working. And even if the Fed disagrees with me, just from a risk management perspective, given how strong the data has been, there is every reason to do another hike in December.
Okay. Yeah, and I think one of the things one of clients was pushing back is also, I guess, on your view next year that they probably go on pause, maybe January to middle of summer, and then they start hiking again. And their question was, which I think is a reasonable one, even if we're in the growth inflation picture that you think, will they hike into election?
They
So
would.
maybe makes more sense to at least get another hike in now.
Yeah, and in terms of the election, there is hikes and there is a hike. There is a very gentle hike, every other meeting telegraphed well ahead of time, and then there is a large surprise hike. And definitely the Fed is not going to go for the second type of hike. But if inflation remains sticky around 4%, as I expect, they're going to have a credibility problem if they don't do anything about it. So we'll see. But meanwhile, this coming week, we have 11 public Fed speakers and 5 of them not making this up on Thursday. Now, on Thursday, obviously, the more important one will be Powell. He's going to speak at the New York Economics Club, which is a very grand venue, a huge room with all the members facing the public. So basically, it's over a lunch typically, and then you have the members of the club on a sort of a podium. It looks almost
hovering
like
above.
and the speaker in front. It almost looked like a meeting of the Chinese Communist Party presidium or something. Right. Anyway, this is quite solemn. And looking at this and looking at the number of speakers, I'm wondering if the Fed is not about to announce a change in policy. One thing that caught my attention this week was San Francisco Fed President Mary Daly mentioning that in her view, the long-term dot is probably higher than 2.5. She said up to 3%. And she added, but not 5%. We shall see. So it could be that, the Fed is trying to announce well ahead of time a move up in the long-term dot in the December SCP. And if you look at the trends in growth and inflation and how they've picked up, and the long-term dot is still 2.5%, same as mid-2019. I mean, obviously, there is a discrepancy there. So it makes sense. But anyway, so I'm going to be busy commenting on Fed speakers next week.
One question I guess I was going to say, if they hike, say they hike in November, but obviously the market it looks like it's more expecting, I guess, December if they do anything. Do you have an idea how the long end would react? I guess it goes with kind of what they're, like, would the bond market more react, say, oh, okay, they are taking this serious, and actually the curve flattens? Or do you think those, okay, they're definitely concerned and that triggers, I guess?
So I actually think the curve would steepen. And the reason I've just published a research piece arguing and showing, actually, the data shows that yields tend to track GDP growth, which makes sense because when you think of it, long-term yields are a proxy for the cost of capital, and the growth rate is a proxy for the return on investment, certainly economic investment. So based on this framework, I'm arguing that, there is scope for yields to move higher. Mustafa thinks 5.5% makes
Yeah,
sense. I mean,
I would
basically,
agree.
we are changing economic regime, and so the whole rates structure is moving up. And so a hike, especially after FOMC members start talking more and more about an increase in the long-term dot, I think a hike would confirm that we are indeed moving to a different regime. And so you could have more of a move in the long end than the short end, because the long end would reflect the regime change.
Okay, interesting. Yeah, a lot of people keep pointing to, so many people are short long end rates. I'm just not so sure. I think people assume everyone is, but in reality, you're still seeing these big nasty sell-offs. So I'm not so sure positioning is as much as people think. And Bilal, I think, brings up an interesting point where a lot of real money is kind of waiting for volatility, or big sovereign wealth funds and stuff are probably more likely waiting for volatility to die down a bit before they kind of really step in. So we could easily see something like 5.5 potentially quite quickly, and I'm not sure the market's really prepared for that. Okay, awesome. Any other big data things? Obviously, Fed speakers, point taken, and any change in the signaling is going to be, I guess, the biggest thing for next week.
100%.
Yep.
In terms of data, most important data is retail sales. So the consensus thinks minus 0.3% month on month, likely because of credit card receipts going down, possible. Though retail sales is only goods, consumption, and restaurants. So there is a lot else going on in the services sector that could make for a reasonable consumption print at the end of the month when we get personal income and spending. So that's retail sales. Otherwise, we'll get some manufacturing data, the manufacturing PMI from the New York Fed, which is so noisy. We also get manufacturing production US-wide. There is an ongoing recovery in manufacturing, and it will be, you can see it in the PMI. It will be interesting to see if there is a follow-through with the US-wide index. And then we get a series of residential real estate indices, the NHAB housing market index, building permits, housing starts. I mean, the consensus is for a pickup in housing starts, which makes sense for the reason we've discussed many times. Not enough existing houses on the market. So paradoxically, Fed tightening is actually supporting a greater investment in housing. So more housing starts. We also get the Philly Fed survey. Again, these are regional surveys, a little bit noisy. Existing home sales, not very much going on there because of the lock-in effect from the very low interest rate mortgages that most homeowners contracted before the run-up in inflation. So that's about it. In terms of politics, we may have a speaker, when there is a new pope that gets elected in Rome, there is a smoke of a certain darker color that gets that gets produced. The US House of Representatives has not moved to that type of signaling yet. I mean, the noise that we are getting are that it's a bit of a contentious issue among Republicans. But one interesting thing that I picked up, one of the contenders, Representative Jordan, was said to be actually considering a 6 months CR, so continuing resolution, when the current resolution expires. Now, obviously, we don't have the details, but it's a hint that, there may be a scope for a compromise and we might avoid a shutdown. So let's see where things stand, but in terms of what to look for next week, the election of the new House Speaker is definitely up front and center.
Yep. Okay, awesome. And as we always like to do, I'll just highlight some of the interesting pieces, say over the past couple days, 4 or 5 days. Of course, one of your pieces continuing hello higher yields, so continued move higher in especially in the back end in US yields. Bilal breaks down what he thinks the potential market impacts could be, and obviously no one wants this, if the Israel-Hamas war escalates to wider across the region. Nice little piece from Bilal and Mirza on carry, why that continues to perform even in this environment, and I'm assuming it would do today, where high yielders are able to withstand the higher rates, but the low yielders are getting impacted by these moving yields, specifically things like Swiss and yen. And then I saw Varesh's piece where he's looking to analyze traffic congestion across North America and Europe, and why he believes that points to actually quite robust gasoline demand, and that should help keep oil prices supportive. So again, our view is we're pretty much in an 80 to kind of 95, 80 to 100 range, and we're closer to the bottom of the range, and most likely continue to see fairly strong demand as you guys test to specifically for the US, and that should keep oil prices as well very supportive. That's it. I hope everyone really is enjoying, doing well in the markets, is enjoying our product and analytics, and obviously any thoughts, feedback, as always, we very much welcome.
Absolutely. So good luck, everybody, and looking forward to feedback, especially pushback. Most welcome. Helpful.
Awesome.